There are two ways to invest in property. The hard way is to buy a property and wait, maybe for years, hoping it improves in value. The other way is through active investment in development projects, where approvals and subdivision potentially add value to the property. You may think that this kind of investment takes funds and expertise, but that's where CFMG comes in, with our Land and Opportunity Fund. We give you the opportunity to invest in significant development projects with as little as $25,000 using our specific investment criteria. This opportunity also provides diversification across multiple projects. By pooling your funds with those of like-minded investors, you can invest in development projects that are typically out of reach to everyday investors. When you invest, you are investing in the transformation from one large parcel of land into smaller, subdivided residential lots. While our analysts assess and investigate many projects per year, only a select few meet the specific CFMG criteria. Here's how it works. Once you've registered your interest with us, we'll contact you when a project investment opportunity becomes available. We'll send you detailed information in the form of a product disclosure statement, including the project criteria, risks, and returns. If you decide to go ahead, your funds go into a pool used to purchase the land and complete the project. Our experienced team then manages the project through construction, subdivision, and sales, keeping you up to date throughout the entire process. If the project is completed successfully, then you get your initial investment back, plus any profits calculated using a fixed percentage return each year. You can repeat this process as often as you like, reinvesting your initial investment plus any returns into the next project. The CFMG Land and Opportunity Fund is open to all investors. It's a property investment with no agents, no maintenance, and no unpaid rent. You just sit back and relax while the experienced experts run the development for you. Our business holds an Australian Financial Services licence, so you can be confident that your investment is professionally managed in a regulated environment. So why not give us a call and see how even a small investment can produce returns for you?
Thanks, Darren. So yeah, as Darren said, just going to talk about the private credit market. It's definitely a hot topic at the moment. So just focusing a little bit on this, give a little peek behind the curtain. And probably the idea is not to talk about what's better and what's worse, but what's just the differences and how it might fit in your portfolio. So get the formalities out of the way. I'm not licensed to give you personal advice or general advice, just giving factual information about our products and the market, and I am entitled to an opinion on the market, just not your circumstances. About me, I've got about 25 years experience now in this field, been with CFMG Capital since 2012. And I'm just trying to make it as general as possible, as I said, talk about the market we're operating in rather than CFMG Capital itself too much. Don't want to sit here and recite bullet points, but that last one you'll see, I do enjoy this event as well, so it comes along around school holiday time when you've got 4 kids. It's a good way to get on the road, get away from it all. So Darren times it nicely for me most years as well around AFL finals, so must thank him for that. About private credit, estimates now put the value of private credit investments at over $250 billion. So the spotlight is well and truly on this space now. You'll note I'll talk about inaccessible markets there. And what I mean by that is sort of small retail investors, SMSF investors or trustees, can now get exposure or investment opportunities into fields like property development and other private credit sectors, traditionally always reserved for the ultra wealthy or the ultra high net worth. And we think that's a good thing, the democratisation of what's a pretty good investment option for most portfolios these days. It is now a mainstay in many self-directed and or advisor-directed portfolios and a core component of people's defensive allocations. given it has been able to produce income and returns across many volatile cycles. So what is private credit? Contrary to popular opinion or some opinion, it's not lending of last resort. In fact, we find it's more efficient lending with more specialised expertise. Often businesses these days, SMEs, property developers, venture capital or new startups, they'll prefer private lenders. They're better to work with than the banks. And the rates aren't miles apart as they once were, thanks to the competitive nature of private credit markets these days. And of course, regulatory changes on the back of the GFC have restricted some bank lending. So specialised private investors are filling this gap. And Gary from Holden Capital, who's coming up, I think, after the break, he'll go through in a bit more detail. But essentially, banks don't want to play in this space anymore. They like to think they do or present like they do, but essentially lending money for 12 months to a business doesn't make them money. Lending money to retail mums and dads, mortgages for 30 years, that's where they make their money. So they prefer to deploy all their capital into that retail mortgage market rather than into business banking, which has created opportunities for the specialists in the private credit. The structures of private credit, one very small example I've given there is, direct investment, so just purchasing investment property. There's nothing wrong with that. Certainly something I do. But obviously that requires equity, typically comes with significant debt, often playing game of balancing, some desire for yield as well as potential capital growth, and or against the rare occasions, particularly in residential property, for capital loss or reduction in your capital. Very uncommon, obviously, in residential property in the last 10 years, but there are still small pockets like regional markets, mining towns, and inner city apartments that have seen some capital reductions in the last 10 years despite the booming residential property market. There are different opportunities, and I'll go into that in the next slides, but particularly what we call contributory funds versus pooled funds. We operate both. It is particularly more so in the advisor networks and the rating agencies. For reasons unknown to a lot of people in the space, they prefer the pooled funds in their ratings and particularly advisor networks, but I think it's more they just prefer the open-ended period that a pooled fund offers versus contributory schemes typically have an open date and a close date. Talking about liquidity, as I said, contributory schemes, despite usually containing single assets, obviously they require the terms of the loan to be honoured. For us, we operate the monthly income fund. The liquidity on that, there's a lock-up period for 12 months, but really it's essentially 13 months, because once you've hit your 12 months, it's approximately 20 to 30 business days post-redemption request where you will receive your funds. We also have our Land and Opportunity Fund, which is a contributory fund, and that one is locked up for the advertised period, and there's no income or early redemptions available. So once you go into a contributory fund like our Land and Opportunity Fund, all your returns are paid on completion of the investment. So it's important to understand the differences, particularly in liquidity, when you start investing in this space. Sort of taking a look under the hood, keep talking about contributory and pooled funds. What I mean by that is a contributory fund is a single asset or a known asset or known pool of assets prior to your investment. So when you invest your capital with that private lender or private creditor, you will know exactly what your money is being lent against. You'll know the exact property or exact business or whatever that might be, and you go in eyes wide open. Whereas when you're investing in a pooled fund, there'll be an investment mandate of some kind, but you're placing your trust in the manager to ensure that they act in accordance with the PDS and invest in properties or businesses that meet the mandate that's outlined in the PDS. And for that reason, that's why it's somewhat interesting that the rating agencies and advisor networks prefer the the pooled funds, given the less detail available when you're investing, whereas the contributory fund obviously has the benefit of knowing exactly where your funds are going. So it's important to look at a manager's track record and who they're lending their money to. In terms of security as well, it's a very simple waterfall of capital where it ranks. First mortgage, obviously the gold standard. Second mortgage, mezzanine, and general security agreements. It's very important to understand where each of these things rank. Also understanding what the borrower's capacity is to repay the debt, what is their track record in terms of, if they're a property development space, have they completed a project like this before? What's the market doing? What's their performance in this space? If you're investing in a business, have they done a startup before? Are they experienced in that space? But does the lender in particular have the expertise to fix things if something goes wrong? So particularly if you're a private creditor that's lending out to various businesses, if they're lending out in the venture capital space or an SME, what expertise do they have in that field if they have to step in, so to speak, and fix things? Same thing happens in property. If you invest into a property development or a property asset and things aren't going so well, what is the manager's ability to step in rather than just liquidate the asset? And in that investment mandate, being really clear about the assets and the loans, do they match the fund objectives and criteria, avoiding what we call mandate creep. So someone says, they only invest in a certain type of product and it's got to be near a capital city or it's got to be this, and next thing you know, they're investing in Kalgoorlie and it fits most of the criteria but not all of the criteria, so ensuring that the manager is sticking to the investment mandates. Obviously, diversity. So for us, we think there's two types of diversity. Diversity is obviously a very important part of any investment strategy. But there's different ways to achieve that diversity. So you can achieve diversity through your fund, or you can achieve diversity through the portfolio. And what I mean by that is you might be able to invest to someone like La Trobe in a fund that invests across residential property, retail property, commercial property, industrial property. Therefore, you're achieving your diversity in that space through a single fund. You may also choose to invest in 4 or 5 different funds, one of them being a specialist in residential property, one of them being a specialist in industrial, and one being a specialist in commercial, and so on. So there's different ways to achieve that diversity. Obviously for us, we are specialists in residential land only. We don't build anything in terms of anything above the ground except for a retaining wall and a power pole, we don't build. So our specialisation is purely in residential land subdivisions. And we focus on that because that's where all our expertise lies. So there's great opportunities in apartments and townhouses and things like that, but that's just not a place we play in. So we find, if you want to get expertise, you can invest with us if you want that residential exposure, and then you might invest with another partner, like the Holden guys that are coming after us, who typically lend to apartment developers and so on. So the ability to diversify across different funds rather than one fund is certainly opportunity. Talking about related party and unrelated party lending. So what I'm going into there is most funds do source opportunities from unrelated parties. In the property sector in particular, this means that the lender will work with upwards, depending on the size of the fund and who they are. Some will be lending money out to over 100 different developers or businesses of that nature. So getting an understanding of who they're lending to and where your money's going is quite difficult in that space. Then you've got someone like the guys coming up after me, Holden. They do lend to other parties, but they have a select group that they work with. Whereas us, we are unashamedly a related party lender. In our view, it does create potential, huge benefits because we understand each project from start to finish. when you're assessing where you're giving your money or lending out the money, you can, talking about the quality of a project or an asset. A good example is some developers, if you look at some of the offers that come out from various private creditors, they're lending for the purposes of completing a development, but the asset security is often the principal place of residence of the developer. So in that circumstance, it obviously means that the creditor doesn't believe that the project itself is sufficient asset to lend against, but it also tells you that the developer themselves believes in it so much that they're putting up their personal home. So certainly requires a lot more investigation, in my opinion, if you're investing in a fund like that. But it's just a good example of just because they're deploying the capital into a project, it's not actually the asset that you're borrowing, that they're borrowing your money against. So CFMG Capital, as I said, we fund only developments being undertaken by our development team. For us, that gives a full alignment of interests. If a loan goes bad or a project has gone bad, that puts our equity and our funds on the line as well, not just our investors. So the old saying of skin in the game, we consider that a really important factor in the private credit space. So projects that we lend on, we've built them from an embryonic state. We've identified the site, we've assessed the site, we've acquired the site. We're now ready to deliver the project when the private credit invested. So we know the projects inside and out. And for us, investor outcomes in that space are key. We can take what we call unpopular decisions in our development arm in order to protect the interests of investors, and we can make hard calls, where some borrowers won't do that, as it's not their reputation at stake when it comes to investment returns. It's only their reputation at stake in how that project performs. So if a project goes bad, for example, the investors can suffer, but the asset manager merely just suffers some reputational damage and some lost fees. In the space of the related party, if a project we're doing goes bad, touch wood, our direct equity and our own funds are at risk, and we rank last behind the investors. So for us, we do have a 100% track record of performance over 18 years, and it's one of the most important metrics in the business. It's a key to the business. The investors trust us because we've repeatedly delivered across market cycles and in really tough markets. And we think the reason that we're able to deliver that 100% track record, one of the few that have it, is because we know every project inside and out before we get involved, or before the private funds are deployed. Also, from an origination perspective, it provides a lot of flexibility. So some larger developers in this space now have a minimum project size of 1,000 lots, and this has reduced competition, which is great for us, because some of those guys are just seeking scale. We're seeking value, so that's our main focus. Just in Brisbane alone right now, we have projects as small as 10 lots, and land is starting from $2 million per lot in a project like that, that's in the inner city, whereas we also have a 1,500 lot subdivision in North Brisbane where land starts at 350,000. So that our size and our structure allows us to consider deals across the entire land development spectrum rather than having a really narrow focus. Despite that, probably the biggest challenge in this space, certainly in our business and in the development business, is acquiring sites that are ready for development. We all read about the housing shortage constantly, and it's typically it's government bureaucracy and red tape that's holding up the reduction in land. But with 500,000 new people coming to Australia every year, we've got to build more houses. So that's the greatest challenge in this space, and being able to be nimble and identify a site that's developable is really important for our business. But we would look at over 500 deals a year and transact on less than 10. So, and of those 500, 250 might make sense, but someone outbids you. So that's the toughest part of the space at the moment. Going into a little bit more detail about the funds that we operate, or investment model, the main one that we'll be talking about, because it's our only real fund that's open at the moment, the others are fully subscribed, is the monthly income fund. And that's essentially quintessential quintessential first mortgage private credit fund. And that's a series of loans secured through active projects. So across our entire residential development portfolio, that money is deployed with first mortgage security over each of those assets. It is a pooled fund, open-ended, with a capital benchmark or a capital ceiling of $200 million, of which we've got about $50 million invested at this point. The Land and Opportunity Fund, that's where we create value through development. So we're taking an existing asset, turning one lot into 100 lots, and that's where you create real value. That is not secured by a first mortgage. That's the one that it's all created through the development process, so all the returns are paid at the end of the process because there is no income in the development until the project's completed. And that was what we built the business off. That was the flagship fund, but unfortunately, there's a long waiting list to get involved in that fund currently. And then our final one is our first mortgage and income fund, not particularly creatively named. It's similar to the monthly income fund. It's a first mortgage paying an income, but it's a quarterly income and it's not used for any development. So it's more creating value through approvals or rezoning or through the land banking process. And I'll go into a little bit more detail in another slide, but these are our three sort of main funds. So the monthly income fund, we launched this in March 2024. It's got over $45 million of investor funds deployed across our portfolio. It allows us to be a more efficient developer. We still have typical loan agreements, similar LVRs to the banks at up to 70%, pre-sale hurdles, so it's not just willy-nilly lending. And it was developed by us largely in response to demand from our existing client base, who were looking for a regular income stream from a manager they trusted. So we spent 4 years working out a way to provide an income on a monthly basis, because when you're a developer, as I said, most of that, the funds or the returns and the value come from the completion of development, but we found a way to do it through replacing the bank, so paying your rates each month across our entire portfolio and pooling all those assets. And it is deployed across those strategic pipeline of projects across the CFMG Capital portfolio, currently largely weighted to South East Queensland, not because we're a South East Queensland-based business, but because that's the strongest residential land market in the country at the moment. We are exiting and just finishing off projects in Melbourne at the moment, which is good timing given the state of the Melbourne market, and we're investigating new opportunities in Perth and Adelaide as we speak. As I said, the Land Opportunity Fund, there is a large waiting list. I think we do have a few investors in the room. It's a reliable, experienced team with a strong track record. It is essentially mezzanine finance paying a much higher return, but I guess, with a track record over 18 years of 100% performance, our investors do, I think 91% reinvestment rate. It is a contributory scheme. It's a loan debt product. You aren't directly investing in the project, but you're exposed to a single project and a single asset with each investment with a clearly defined time frame in advance. It's important to, I guess, look at the key metrics and what goes into the Land Opportunity Fund, though, because that lends itself to how the monthly income fund operates. So the key metric to define a site as a developable site is, does the opportunity provide an appropriate forecast return at or above our target if land values at today's date remain as they are? If the answer to that is not yes, then we'll just move on. The answer to that question has to be yes before we get into more detailed analysis. The analysis inputs, a lot of stress testing, completed land values. What does the model look like if land values decrease? What does the model look like if construction costs increase? What happens if both costs go up and values go down? And I'll give you the tip, nothing good happens when that happens, but we do have to have a look at it and see what it does to the model. And then there's all these other, I could be here for hours explaining the nuances of development, but if you're building you have to build an intersection, whether you're going to get credit from council or whether you're paying for it yourself, an intersection upgrade might cost $5 million. So you want to know before you build it if council are going to contribute half that money, all of that money, none of that money, because that blows a hole in your entire budget. So you've really got to understand where the services are, trunk infrastructure, koala mapping, environmental concerns, creditable versus uncreditable, sewer upgrades, bushfire, flood mapping. It's a very involved process, so expertise is really, really important. I love to give an example, certainly in the koala mapping space, that's just council officers looking at overhead maps and colouring in maps a different colour and saying you can't develop that because there's a bit of greenery. That particular 10-lot subdivision I was talking about before, that had a large swathe of trees on it when we first started looking at the site. We were told you can't develop that portion of the site due to the koala habitat. Visited the site and it's 3 hectares of pine trees. Obviously koalas don't live in pine trees, so after a bit of back and forth, took 12 months of negotiating with council for them to finally accept that there's no koalas living in the pine trees, and we were able to clear that area for development. But understanding that process and being involved in experiences is particularly key in how to get those developments done. I'll quickly skip through the First Mortgage Income Fund because my time's quickly running out. But what I was talking about before is this one is not used to operate development. And probably the clearest example I can give is just the most recent fund we operate in this space. We purchased a potential development site, so not a site that we know we can definitely develop. The cost was $3 million. We get a valuation as is, where is, whether it can be developed or not. And then we spend 12 months either trying to get it rezoned, get an approval, and that way you create significant value via that rezoning or approval process. We spent 12 months doing that and were unsuccessful. So the options at the end of that 12 months were to then resell the asset back into the market. If it had not had any increase in value, it's still worth $3 million. We've only borrowed 2.1 against that. Typically, even though we hadn't got it rezoned or approved for development, there was some market uplift. We felt we still had a chance to get it approved, so we offered the opportunity for investors to go again for 12 months. And then recently we were able to get it rezoned, didn't get a development approval, but the neighbouring developer who owned the site next door came along and paid $5.5 million for the site. So we were able to pay out the investors and take the value without even developing the site. So that's how the First Mortgage Income Fund works. It is a contributory scheme, paying a quarterly return, and it's usually capped at 12 months. Quickly skip into who we are. We have over 2,000 investors now and $200 million of funds under management. We do have an independent board and investment committee. If you're familiar with Cromwell Property, so our chairman Ross was the founder and managing director of Cromwell Property. Barry is our compliance coordinator and compliance manager. He's uniquely qualified for this as a former regional commissioner of ASIC. Jim Frayne is a business specialist. So he's essentially these days in retirement a professional director that provides strategic advice and is director of a number of other businesses. And then Jason's probably a more specialist skill set. He runs a valuation firm. Obviously, due to conflicts, we can't use his valuation firm to value our assets, like someone like Blue Sky, for example. But he provides, really strong advice in that space before we go out to the valuation network. Completed investments in the last 5 years, the Land Opportunity Fund. These are what's completed, so we can't get too excited. We're more in the sort of 9.55 to 10.55 space these days. But that since inception, the Land Opportunity Fund has returned over $150 million in capital to investors with an average weighted return of 11.68%. But essentially, every time we've forecast a targeted return, that's what we've delivered. So while the average is 11.68 or we've delivered 12, it'll come down to what is in the offer at the time that you chose to invest. And then completed investments in the First Mortgage and Income Fund, you'll note due to the much higher security, shorter terms, the rate comes down significantly. And they're the funds that we've delivered in the last 5 years. In terms of the monthly income fund, since inception, it's delivered 8.25% per annum on a monthly basis. This slide probably needs updating slightly. So it is a variable rate. And as I understand it, we'll be reducing the rate to 8.05 as at 1 October. So while it's 8.25 for a couple more weeks, it would be remiss of me not to confirm that it's dropping to 8.05 in the next 30 days.